Oil marketer Kenol Kobil has reported a 19.7% rise in net profits for 2016. It's boosted by high sales and lower finance costs as well. The company's net earnings in the period was about $22 billion compared to $19 billion in 2015. Sales were up 19.5% as well. Kenol Kobil's management pointed to its aggressive move to solidify the company's position in the market. It's added 30 retail network stations in the year, and it also benefited from a 45.5% decline in its funding costs. I'm now joined in studio by its Managing Director, David Ohana. Thank you for your time.
Good evening.
Strong numbers all around. At this rate, I shouldn't really be betting against the company. But let's start with the broad figures here. Net sales up 19.6%, but let's split that number further. How much of that was due to an increase in volume of sales, and how much of that was attributable to higher sale prices?
We grew by 30%. Sales grew over the year 30%, and you know, January last year, the barrel was the Marban, the one we are refining in Kenya, was around $28 per barrel. Now we are around 55, 54 today. So yeah, oil prices almost doubled over the period, but we gained also market share. And sales, you know, the volume that we generated over the period, 30% up.
You guys used to be the second largest player in the market, but I mean, based on the latest data that I did see, now you guys are the biggest oil marketer in Kenya.
We reclaimed our first position, you know, market leader, but I'm waiting for the official data to come. But
right.
Yeah.
And what about the product categories? Because I mean, obviously, when we talk about oil marketers, we tend to think about fuel stations, diesel, petrol, and so on. But there's a lot more you guys put out into the market. You've got lubricants. There's an aviation fuel business as well. How are those segments doing?
Yeah, we are big in aviation. We are like 40% from the market. We are mainly with the international airlines. We do a lot as export to South Sudan, Rwanda, Burundi, Uganda, from Kenya, from Western Kenya. So it's a big segment for us. And we do a lot. There is a disaster with the drought and all the effect on the economy, but you know, some of us, in a way, benefiting from that. We are big in the power production. We are with Rabbi and Kengen. So in the last 3 months, really volumes are...
because there's been this switch to thermal generation.
The thermal generation. So even for us, this segment is big, and we have 200 stations around Kenya and close to 400 in the group, so it's substantial. It's the biggest network in Kenya today. We took over 30 stations, as you mentioned in the summary. So yeah, these are the main categories. The ones you mentioned, the lubricants, non-fuel, and LPG, they are high margin, but usually small volume.
Right. We'll get back to the retail outlets in just a bit, but there were some interesting numbers coming through in your results. $6 million provision for yield shift losses from KPRL. Tell us about that. Because that number just keeps growing every single year. Yeah,
2017, I hope to finish with it. You know, it's a project we started with the board and management like 3 years ago. We keep dealing with that number. Some oil companies decided to go legal against the government, so-called KPRL. We decided not to do it. We believe to dialogue with the government. We don't want issues in litigation with you know, the government. So we are dialoguing with them. It's an issue that going back almost like 20 years, whereby we couldn't get what we were expecting in our contract with the refiner. And there is an outstanding amount which genuinely to be paid to the oil companies. For some reasons and obvious reasons, we were not being paid, all the industry. So the board decided to act on this number and clean the books. I'm very much for it. And we think we'll finish that exercise in 2017. Luckily, the company is very profitable in the last 3 years. So we were able to deal with this number. And I think by end of 2017,
it should be essentially off the book. But at the moment, because now companies like yours no longer have to bring in crude oil to feed it into KPRL. So that to some extent takes a huge bunch of risk off your books. But now with Esser's exit, is KPRL a firm you guys can do business with in the future? Is it a potential partner?
KPRL, it's a name now. It's actually a tank farm that the Ministry of Energy, with proper leadership now, trying to hand it over to KPC, to the pipeline, as a storage. I think it's a blessing thing for the country. You'll have more stocks in the country. We clean the crude tanks. We don't need them anymore. We convert them to products. So we'll have more jet, more diesel, more PMS. Remember, pipeline is adding another new pipe. So all issue of allege, all the things we were discussing when you were interviewing me in the past are gone. A pipeline will have more than double capacity to pump Mombasa, Nairobi, where the main market in Kenya, and we'll have much more storage. KPRL storage is 400,000 metric tons. It's quite
That's
massive.
pretty substantial. Now, crude prices, as you mentioned, pretty volatile. We started 2016 around 20 or so dollars a barrel. US crude fell even lower than that. But it's more than doubled in that period of time. And OPEC has been trying to cut prices, cut production, to boost prices. How do you hedge against that sort of exposure?
First, we are, apart from Uganda, all countries we operate, you have a formula or price cap, which it's in a way, if you manage your inventory properly, it's a natural hedge. Like 2 weeks ago, I know that 15th March price will go up because we discharged some cargoes in Kenya. We know the cost. We can predict with high accuracy what will be the price. So it gives you time to act on your inventory.
Yeah.
Look, we deal with, I told you we are 40% doing aviation.
Yeah.
And we are 40% doing, 25% of our sales, it's export. All of it comes in hard currency. So in a way, it's a natural hedge on the currency. And on the product, look, I can't give you all the secrets, but the inventory management has a lot to do with the profits. It's not margins that the government gives us.
Yeah.
So I think Kobil, if you ask me what we do different, we manage the inventory in a different way, and it has a lot of value into the numbers, so the 2.4 billion that you're referring to.
Right. Unfortunately, that's all the time we have for today, but always a pleasure having you on the set.
Yeah. Pleasure being here.
Thank you very much. We've been speaking to David Ohan, of course, the Managing Director of Kenol Kobil.